Hello everyone, Professor MoneyPigTrading. Today, August 9, 2024, let's take a look at US Treasury bond and the related ETFs and about the surge in a rate cut cycle. So let's explain why. So Federal Reserve is about to cut rate, first of all, because right now the market, especially the CME interest rate watch website, believes 100% probability the Fed will cut the rates in the September 9, 18, 2024 FOMC. It's because the economy has already been slowing down. In the last 2 weeks, the ISM manufacturing employment rate were lower than expected, and also unemployment rate was 4.3%, higher than the market expected. So how bad is 4.3%? Originally, the Federal Reserve predicted and forecasted that there's absolutely no way the employment rate is going to above 4.1% by Q4 this year. Boom. Then 2 weeks ago, it was 4.3%. The market panic. If you're watching the market, you probably know what happened. The market sell off really bad. Nasdaq down about 12%. Semiconductor index or SMH ETF down more than 20%, already in the bear market. Some recession indexes, depends on which economy clan you follow. Some of those indexes already suggest that we are in a recession. So often during the rate cut cycle, the stock market perform poorly. Or you can say bond usually outperform the stock market during the rate cut cycle. Why? Let's take a look. It's first of all because when Fed often cut the rates, it's already too late. Not until the economy already slowing down like what we have seen right now. When the economy slows down, the public companies' earnings perform poorly, so economy slowdown will negatively impact the stock market and the corresponding stock prices. However, because of the nature of the bonds, when the interest rate go down, the bond price will go up. So in this kind of rate cut environment, the stock market will just perform poorly, or bonds will outperform against stock market. It's kind of like a chicken and egg problem, to be honest. And they're all talking about the same thing. The third thing probably even more confused you, more technical term, when you read those financial articles. Some people start to say uninverted 2-year and 10-year yield curve. If you're looking at this curve, which is the 10-year yield divided by the 2-year yield, now is approaching to zero. That means the 2-year and 10 years yield curve are touching to each other. Originally departed, now they're touching. What this often means in the past 25 years, it means in recession, rate is going to go down, stock market is going to go down because something bad is happening in the economy. It's slowing down. And the last time this phenomenon happened, 2007, 2019. That's the time the stock market performed poorly and the bond market outperformed the stock market. So let's take a look. We'll use TLT, which is a 20-plus year Treasury bond ETF, as an example to represent the bond market, because the bond market has so many different types of bonds, right? You have government Treasury bond, you have corporate bonds, you have so many types of ETFs. TLT is one of the biggest. Let's just use it as an example. So the price action of TLT in the rate cut cycle first, July 2007 to December 2008. If you watch the market, you probably know Lehman Brothers market sell extremely badly. That's the time when Fed started cut rates starting July 31st, 2008, as shown under this figure. And until December 31st, 2008, Fed finally did a last cut. In total, they cut 5.11% of federal funds effective rates. And we have to look at a term here called effective duration. Here, the TLT effective duration is 16.45% is what I assume. But let's take a look what this term means first. It's very important when you invest into bonds. So what effective duration means is a risk measurement. So when a bonds or a bond ETF's effective duration is 16.45, which is a TLT effective duration here. And if there were to be a change in yield or interest rate of 1%, then the bond ETF price would expect to change by 16.45%. That's a really big impact, right? If the yield goes down by 1% or the interest rate goes down by 1% here, that means TLT ETF will go up by 16.45%. So the longer a bond maturity date is, a higher effective duration the bond will have. So for example, again, TLT is a 20-plus year Treasury bond ETF. So its effective duration will be higher than, let's say, a 2-plus year Treasury bond ETF. So that means when the interest rate drop 1%, the TLT, which is 20+ year Treasury bond ETF, the price will go up a lot higher than the 2+ Treasury year bond, 2+ year Treasury year bond ETF. So coming back to this rate cut cycle, so the TLT, I wasn't sure. I could not pull the number. I'm contacting the iShare company, but I haven't got a response. So I just assume back to TLT, back to those days, about 15, 16 years ago, the effective duration is the same as right now, 16.45%. So if you do the math, if there's a rate cut of 5.11%, effective duration 16.45%, theoretically, TLT should go up at 84%. During that time period, TLT actually went up during this rate cut cycle. Again, July 7 to December 2008. The TLT highest return is 44%, while the stock market was performed poorly. It was down like 30-40%, right? So again, bonds will outperform the stock market during the rate cut cycle. TLT, if you just look at these two dates between July 31st, 2007, not 2008, and December 31st, 2008, we're looking at a TLT change in this time period is about 33%, because eventually, at the end of 2008, that winter, December, the stock market and bond market both sell off. First, the bond market is already overreacting during those time. And second, when Lehman Brothers and all those craps happened, everything just got sold off. Even bond was not as protective because of that unique economy situation. So coming back to the next rate cut cycle, again, each rate cut cycle is a little different. 2007, 2008 was a little, I would say, extreme. The other one is also a little extreme. It's between July 2019 and February 2020. Why was it extreme? Because, COVID happened during February 2020, and, all sorts of things happen. But when the rates started to drop between July 31st, 2019 and October 2019, the rate actually down about 0.85%. So again, assume the historical TLT effective duration 16.45%. Theoretically, TLT should go out by 14%. And you can see in this time period, TLT actually popped really quickly. And the highest return in this time period is indeed 13.25%. So, but however, if you're just looking at these 2 days, TLT actually changed 7.2%, because TLT, after popping about 13.25%, actually pulled back a little bit. And then, the COVID happened and all sorts of funny things in the financial market. Again, it's a little extreme. Every time there is a rate cut happening, something happened, So fingers crossed what will happen. And if what I'm saying is true, right, what about what other big investors are doing? So this is CNBC today. It says Warren Buffett now owns more Treasury bonds or Treasury bills than Federal Reserve. Warren Buffett is adding bonds like crazy since last year. So something's going to happen since rate cut is almost for sure. Everybody is adding bonds right now, especially pretty big institute investors. So yeah, this is the first video just to introduce what bond is, how it works, the historical price action. In the next video, we're going to mention our price prediction and also how to play it and how to use options to make decent amount of returns in this time period when the stock market might be outperformed by the bonds. So thanks for watching this video. If you like our Discord channel, feel free to check us out at www.moneypigtrading.com, Twitter, YouTube, Instagram, Facebook group, or MoneyPigTrading. See you guys in the next video. Bye bye.